Hello, thank you for joining us. My name is James Smith and I'm joined today by Grant Patterson, our Chief Investment Officer. Grant, welcome.
Thanks, James.
We've titled this quarter's global outlook as Jib Set. In the context of the volatility of the last quarter, I was wondering if you could perhaps articulate what we mean by that?
Yeah, sure. I mean, it's a term used in sailing, offshore sailing, when you expect rough or turbulent weather to set a jib which protects the boat while still moving forward. And we thought, given where we see markets at the moment and looking further ahead, we think it's actually an appropriate analogy to use about preparing portfolios for potential volatility.
And in the 20 years of managing money for clients with Providence, could you just explain how extraordinary the moves over the last quarter really have been?
Well, it was a stunning reversal. I mean, the markets in December got sold off quite heavily and then have rebounded extraordinarily quickly. And in amongst that, and probably because of that, was the stunning reversal by the US central bank that obviously got spooked by the volatility in markets and probably the freezing in credit markets to announce that they're no longer going to be raising interest rates in the foreseeable future, and they're going to wait to see whether global growth picks up again. And that really gave a supercharge to risk assets.
And in terms of the global economy, with that in mind, how are we seeing the global economy at this point?
Well, clearly the global economies have slowed over the past 12 months. And the real issue now is whether that's finished and we're going to see a pickup again, or whether we're going to see a further deterioration. And in that, there are mixed messages. I mean, the equity markets are obviously looking forward through this and have a view that earnings growth can continue to increase and global growth will rebound. Whereas the bond markets are taking a totally different view, where they are concerned about growth, even talking about potential for recession. So there's very mixed messages. Our view is that we believe that there will be a slight uptick in global growth, and we've started to see some of the forward-leading indicators indicating that. So I think risk assets, while central banks are waiting in the sidelines, can remain reasonably steady, but we're a long way through the cycle, and we think we're certainly more cautious about the medium to longer term outlook than the short term.
And with regards to the Australian economy, we've been articulating for some time some concerns. Could you update us on where we see the Australian economy at this point?
Well, the Australian economy has started to slow a bit from what previous expectations were. We've seen clearly a downturn in residential property, which we've been talking about for some time, and we've been concerned about the household debt levels. And certainly we've started to see property prices fall, which has been well articulated in the press, but also building approvals and construction, which is a big part of the economy. Construction approvals are down by 30% or so. So, you know, there is some real pain in that area. The rest of the economy is being held up reasonably well by government fiscal spending, and so we'll have to wait and see how that offsets each other going forward. But we think that, you know, it's probably going to remain pretty subdued with the election ahead of us and the consumer under a bit of pressure with their debt levels.
And with regards to equities, could you just run us through our current thinking, both domestic equities and international equities?
Well, after the recent run where equity markets were up 10 to 15% in the last quarter, it's been a very strong quarter, we're back up towards the top end of the ranges. I mean, in Australia, for example, if you exclude the banks, you know, the financials, I mean, the industrial sector's trading on a forward PE of about 22 or 23, and that's a pretty lofty sort of level unless there's very strong earnings growth coming through, which we don't see. In overseas, particularly in the States, margins are at record levels. The index is back up to a record level. So you'd want to ensure that earnings growth can continue as strong as what it has been to justify these sort of levels, and that's where we're a little bit cautious.
And credit, it's an area that we've shown concern and we have concern. Could you really just articulate why we are so focused on credit at this point?
Well, I think with credit, I mean, you know, we have got global record debt still, and we've seen a rise in what's called covenant-light loans, which don't have as much security behind them. You've seen a huge amount of flow of funds into structured products, particularly ETFs and the like. Even in the investment grade sector, there's been a much larger issuance of BBB rated securities, which are only one notch away from being non-investment grade. So this is the area that we think could be a problem if the economy starts slowing, and there's a huge amount of refinancing to come up over the next couple of years. In the States, for example, total refinancing is moving from $200 billion up to $1 trillion. So that's an area that we're concerned about, and that's why we're not heavily involved at all in credit. We're more in asset-backed securities or government bonds.
And with regards to property, you could argue the property scenario at the moment from an investing point of view is a bit different. Could you articulate on how we see property at this juncture?
Well, we're cautious of sort of A-grade properties that have been, very well bid. Cap rates have come in very low, so we're not looking for that sort of area in property. But given that the stress is out there, we've spoken to some of our fund managers and we're having a look around for distressed property where we think there's some opportunities. And we're also having a look at sort of boutique type areas where we think there's opportunities, like regional motels, which are providing a very good yield, and we think that there's some opportunities there.
And so we've sort of set the scene there. We are cautious, and there's plenty of reason to be cautious. But opportunities, where do the opportunities lie for us looking forward?
Well, in regards to equities, we'd prefer international equities over Australian equities, particularly given that they're held in offshore currencies. So as the Aussie dollar weakens, that protects the portfolio somewhat. We prefer equity markets outside the US, so Asian markets or European markets are certainly much cheaper. Within property, besides the areas that I talked about before, there is an opportunity in property debt and lending, given that the banks' lack of interest at the moment in credit or reducing the credit area. We're able to invest for clients in developments that have been built that need refinancing, that are first mortgage fully secured, providing a yield of 8 to 9%. We think that's quite attractive, and that's one of the areas that we're having a strong look at and have started to invest for our clients.
And to summarise, the implications for client portfolios at this point in time are?
Well, I think you've got to recognise that we're very late in the cycle. There is still record global debt, but there is a lot of volatility. So being nimble is certainly something, and we took advantage of that in December, where we deployed some of the cash into equities after the big sell-off. I think you also need to be cautious, so retaining a reasonable level of cash to be able to deploy in a downturn, I think is very important. And I think the most important thing is having a look at your portfolio now and looking at every asset to make sure you're happy to own that if there's a downturn or when there's a downturn. And that's what we're going through with all of our portfolios at the moment.
Thank you for that update. Are there any updates you'd like to share with us regarding Providence?
Yes, James, I'm delighted to announce that Melissa has had a baby boy, Lucas. Both mother and son are doing very well, so we're delighted about that. Also, the lunches, the quarterly lunches are coming up, which everyone can save the date, June the 18th in Sydney and the 20th in Melbourne. We look forward to seeing everyone there.
Fantastic. Thank you for the update, and thank you for watching. We look forward to updating you again in a quarter's time. Thank you.